For much of the past decade, capital allocation decisions were made in an environment that quietly encouraged boldness. Money was cheap, borrowing costs were low, and access to funding felt almost guaranteed. Businesses could afford to deploy capital aggressively, knowing that refinancing or additional funding was usually available if plans didn't unfold perfectly. In 2026, that environment is gone. A higher-cost economy has forced U.S. businesses to fundamentally rethink how they allocate capital, and the changes run deeper than simply spending less. Capital allocation is no longer about maximizing growth at any price. It is about deciding which uses of capital are truly worth the cost. Every dollar now competes against higher interest expenses, stricter return expectations, and greater uncertainty. This has reshaped how companies evaluate investments, manage risk, and define strategic priorities. One of the most important adjustments is a higher return threshold for new investments. In a low-cost environment, projects with modest or long-dated returns could still make sense. Today, higher interest rates raise the bar. Businesses are demanding clearer, faster, and more reliable payback from capital investments. Projects that once would have been approved are now delayed, downsized, or rejected because they cannot justify the higher cost of money. This has led to a noticeable shift toward core business investment. Instead of allocating capital broadly across expansion initiatives, companies are concentrating resources on areas they understand well and where returns are more predictable. Maintenance, modernization, efficiency improvements, and risk reduction are receiving more funding. These investments may not drive rapid growth, but they protect margins, improve reliability, and support steady cash flow. Debt management has become a central capital allocation priority. In a higher-cost economy, debt is no longer a neutral tool. Interest expense directly erodes profitability and limits flexibility. Many businesses are allocating capital toward paying down existing debt or refinancing to reduce exposure. Lower leverage is now seen as a strategic advantage rather than a missed opportunity. Reducing financial risk has become as important as pursuing growth. Cash preservation is another major adjustment. Companies are deliberately holding more cash on their balance sheets than they would have in the past. This is not indecision. It is a response to uncertainty and cost. Cash provides optionality. It allows businesses to absorb shocks, avoid expensive borrowing, and act quickly when attractive opportunities arise. In a higher-cost economy, liquidity itself has value. Share buybacks and shareholder returns are being evaluated more carefully as well. While returning capital to shareholders remains important, companies are weighing these decisions against the need for financial flexibility. Buybacks are more selective, often tied to valuation discipline rather than routine programs. Capital is less likely to be returned if it weakens the balance sheet or limits future options. Expansion strategies reflect the same caution. Businesses are slowing geographic expansion, delaying large capacity additions, and favoring incremental growth over big bets. When expansion does occur, it is often phased. Capital is released in stages, with performance milestones required before additional funds are committed. This reduces the risk of overextending in an uncertain and expensive environment. Mergers and acquisitions have also been reshaped by higher capital costs. Deal-making has not disappeared, but it has become more disciplined. Companies are focusing on smaller, strategic acquisitions that strengthen existing capabilities rather than transformational deals that rely on heavy leverage. Acquisitions are expected to contribute to cash flow sooner and carry lower integration risk. Technology and AI spending provide a clear example of adjusted capital allocation. While businesses continue to invest in these areas, they are doing so with more structure. Large, open-ended technology bets are being replaced by phased investments tied to measurable outcomes. Capital is allocated to projects that improve efficiency, reduce cost, or enhance decision-making, rather than speculative innovation alone. Operating cost structure has become a key consideration in capital decisions. Companies are asking whether investments increase fixed costs or improve flexibility. Capital that locks the business into rigid cost commitments is scrutinized more closely. Investments that support scalability without permanent expense growth are favored. This reflects a desire to remain adaptable in a higher-cost environment. Investor expectations have reinforced these changes. Shareholders are less tolerant of aggressive spending that does not translate into clear financial performance. They are looking for disciplined capital allocation, strong returns on invested capital, and evidence that management understands the trade-offs created by higher costs. Companies that demonstrate restraint often earn greater credibility, even if growth slows. Internal decision-making has evolved alongside these pressures. Finance teams now play a larger role in strategic discussions. Capital allocation decisions involve more cross-functional input, deeper stress testing, and clearer accountability. Leaders want to understand not just upside potential, but downside exposure and recovery options if assumptions fail. Scenario planning has become part of the capital allocation process. Businesses are evaluating how investments perform under different economic conditions, interest rate scenarios, and demand environments. Capital is increasingly directed toward initiatives that remain viable across multiple scenarios rather than those that depend on ideal conditions. Another important shift is the emphasis on return on invested capital rather than absolute growth.